Hi friends, welcome to A to Z Learning channel. Today's topic is Indian stock market and what is happening in the Indian stock market. Barely a day goes by these days without a headline about the Indian stock market. Every day virtually Sensex or Nifty Bank is climbing to the all-time high levels. So what is happening? This is $1 million question in the minds of most retail investors. So in today's video, we'll first help you understand how the performance has been for Indian stock market. We'll try to compare it with some of the other markets as well so that you get a feel in terms of overall perspective. And then we will touch on the most important question, which is, should you be concerned about this? And if yes, what can you do about it? So this is going to be an important video for a retail investor who's wondering what is happening in the Indian stock market. So without any further delay, let's start our video. As I said, in the first section, we will talk about the performance of Indian stock market. So let's understand how the market has performed so far. On the screen, you would have seen some of the kind of points that have come. First of all, you should be proud to note that India's market cap is now over $2.7 trillion, which is very close to its GDP. It's currently 94% of the GDP. India has also moved forward in terms of the market cap. It is now the seventh biggest market in the whole world. It is ahead of countries like Germany, Canada. So it's really doing well from a market capitalization perspective. As I said earlier, both Sensex and Nifty indices are at their all-time high level. In fact, every day, almost every day, they climb to a new high. And the other thing to kind of highlight in terms of performance is that when you look around the world, Indian market is the second fastest growing market. So that's again says a lot that the markets are really bullish. Markets are record level. So is it too expensive now for a retail investor to participate? How does it compare with other market is the second question that comes. So now let's understand the comparison with market. A table has come on your screen. In this table, we have picked up the top 10 markets by the market capitalization and tried to kind of give you some key stats to help you understand what is happening around the world. So let's pick up the first row, which is the largest market in the world, US. US market in terms of market capitalization is over $44 trillion. And it has so far in this year has changed or grown by 3.89%. Its GDP is 21 trillion. So if you look at that Warren Buffett indicator, Warren Buffett, who's the most successful investor, he always uses a indicator called Buffett indicator, which is basically the ratio of market cap over GDP percentage. The same for US is 207%. So hope this first line makes kind of sense. Let's pick up the second largest market, which is China. China, in terms of market capitalization, is $11 trillion market. It has grown by 2.5% this year. Its GDP is 14 trillion. So from a Buffett indicator perspective, it is now trading at 78%. And Buffett, Mr. Warren Buffett have always said that if the markets are more than 90%, they are in the overvalued valuation zone. But if they are below 90%, then they are more fairly valued. So I hope the table, the way I've set out the information makes sense. Now we'll highlight a couple of points here. If you look at from a market capitalization perspective, India, which is at the seventh number, is at $2.7 trillion approximately, and it has grown by 6.94%, which is second to Hong Kong. Hong Kong grew more than 8.5%. If we look at India's GDP, which is the third column on this table, India's GDP is roughly about $2.9 trillion. So $2.9 trillion GDP, market cap of 2.7 trillion gives us a percentage that India's stock market capitalization is now at 94% of its GDP. So Warren Buffett indicator is 94%. Similarly, I have covered some of the other countries like Hong Kong, Japan, UK, France, Canada, Germany, Saudi Arabia. These are the top 10 markets in the world by their market capitalization. But the last line is where if you put together all the markets in the world together and see what is happening, then this last line is very interesting. So as a world, the market capitalization currently is at a $106 trillion, which has grown by almost 3% this year. So again, world has grown by 3%, but Indian markets have grown almost 7%. The GDP of the world economies all put together is currently at $88 trillion. So relative to GDP, the market capitalization of all the world economies is at 121%. So overall, it is bullish. Overall, you could argue that the stocks worldwide are overvalued if you apply Warren Buffett indicator, which is basically market capitalization expressed over GDP as a percentage. And if it is more than 90%, then it is considered overvalue. So then the question comes, the $1 million question is that should you be concerned? Because if this is all is happening to Indian market, and we've looked at now in comparison to the some of the other leading markets, then the question comes in your mind as a retail investor is, should you be concerned? And now we'll move to the second section of our video. Hope you're liking our video. If you're finding it really helpful and clear to understand, please press the like button and also share our video with your friends and family. And please do provide us your comment, because those comments are very, very important for us to gauge whether we are hitting the mark, whether we are meeting our viewers' expectations or not. So we look forward to your comments and lots of likes on this video. Now we are in the second section where we will help you understand the key question, given the market performance, given the levels at which it is trading, should you be concerned as an investor? So let's understand. If you look at the Buffett indicator, as I've expressed a few times, it is, if it is more than 90%, market is considered overvalued, bullish. So as a prudent longer term investor, that's not the time for anyone to be investing in. And if you purely look at this stats, India is at 94%. So you could call it that India is in the overvalued bullish zone, whereas a longer term investor, you should be holding back your money. This is the time to kind of book your profits on your existing investment. This is not the time for you to be investing, making newer investment, because you may not get good value for money investment opportunities in the market. So that's the first observation. The second part is that clearly India in isolation relative to that Buffett indicator looks overvalued. But when you look at the data of the top 10 markets that we have shared with you, with the exception of only three countries, India, China, and Germany, every other market is significantly higher than 100% of their GDP. So you could say that it's a worldwide phenomena, that liquidity that the central banks around the world are pumping to revive the economy is chasing the stock market, and therefore every single market is significantly overvalued in terms of the Buffett indicator. So there are, most markets are trading above 100%. So therefore, you could argue that India, relative to all other key market, is fairly valued. So that's the kind of counter argument that you need to be kind of thinking about. But then let's go deeper in terms of Indian context. What is kind of happening in favor of Indian stock market to be operating at the level at which it is operating? First of all is the FIs, which are the key contributor in terms of driving the market. In India, they have invested in this year already, which is only 6 weeks period, over 4 billion, just over $4 billion in Indian market, which is the second to Brazil. There's only one other country where FIs have invested more than what they have invested in India market, and that's Brazil. So that says quite a lot that the valuation is where it is. FIs are pumping money because they are still probably seeing the value in Indian market, and therefore they are investing more money in India. What are the other factors that are supporting the sharp rise in markets in India? I think first of all, everybody will agree that there is a faster recovery in domestic market, domestic demand for India post COVID. Nobody expected it to kind of recover so quickly, but of course we as an Indian market have seen a very faster recovery in the domestic demand. The other part which is really important to highlight is government is taking a very active interest in reviving the economy. They're doing everything that they have at their disposal to really revive the economy. And the most recent budget is a clear statement in that direction. They have they have provided so many kind of great provisions to really revive the investment in infrastructure, real estate, uh, and they are going on an aggressive privatization program. So overall, you could say that it's a landmark budget which clearly endorses the intent from the government that they are all focused about reviving the Indian economy. So when you see a favorable policy framework, favorable government intent, faster recovery in terms of demand, companies are now pretty much operating at 100% capacity. Foreign investors pumping money because they still see value in the market. It's all adding to the growth of Indian stock market, and therefore, it all seems to be kind of positive kind of framework. But important thing is that should you be concerned? Again, should you be concerned is the key question that we're trying to help you answer. Levels of the markets are at alarming level. They are at all-time high level, whereas GDP and the economic revival is still slightly longer term. So you need to be extremely watchful in terms of where you invest. Therefore, I think the most important thing for you to kind of safeguard your investment interest is to stick to the companies that are fulfilling three important things. First of all, you must be investing in the company that are on a growth trajectory. They're still growing. The second, you must make sure that the companies have got great quality management teams. And where possible, the companies you should look to invest where they have got a competitive advantage. Means they are either in a operating in a monopoly or there are heavy entry barriers for other players to come in the market and take their market share. You should always look for those sort of competitive advantage sectors and companies in those sectors. So we really hope that this information that we have shared with you has helped you understand what is happening in the market and should you be concerned and what can you do if you need to be concerned about it. So we hope this was all easy to follow, easy to understand. We would look forward to your comments. We would look forward to your comments. We would look forward to, if you really like the content, we would really look forward to you kind of pressing the like button and sharing our video with your friends and family. And if you've not subscribed our channel A to Z Learning as yet, we would urge you to please subscribe, become part of our viewers family so that you can make the suggestion in terms of the topics that we should make our future videos for. So thank you so much for spending time with us, and thank you so much for watching our video.